Technology has enabled great access. Technology can't do anything about the behavior. You will get greedy at the wrong time. You will get fearful at the wrong time. Rigorously probing mindset. You have to start with the whole thinking that I'm being conned. Now something has to prove that you are not being. This is the opportunity. This is also the biggest threat. This is actually biggest challenge for most individual investors, how to manage their own behavior. They could be their worst enemy. If you don't have your foundational money, then the moment you hit your first loss, you will bail out, never to come back again. बड़ी सारी इच्छा कम हो जाती है जब आपको लगता है कि आप एक लिमिटेड मीन्स में सब चीज किया जा रहा है. एंड द चार्म ऑफ रेगुलर इन्वेस्टिंग, समथिंग व्हिच फिट्स इन विद योर इनकम साइकिल. बट व्हाई एक्यूमुलेट एंड देन इन्वेस्ट?
Mira Asset Investment Managers presents a new conversational series, Let's Tech, Tech with an X. Hello everyone. Welcome to another episode of Let's Tech. This time we are coming straight from Delhi, and with me today is possibly the original goat of platforms, Mr. Dhirendra Kumar. Thank you for coming and joining us today.
Thank you, Srinivas, for having me here.
On the background of what Dhirendra has been able to achieve over the last almost getting into the 40th decade, 40 years of doing this investing, community building over a period of time, I want to start off, where did this seed actually come from? What were the growing up days which has got you here and all your experiences? What was that one tinker which happened?
It was not in the growing up stage. It happened somewhat later, but yes, that was actually the foundational thing. I became very curious. I grew up at a time, when money was serious and information was scarce. I don't know, there was no television. You had Doordarshan and weekly movie and things like that. I'm talking of late 70s and early 80s. And I grew up, and organized workforce was government servant. Entrepreneurship, was limited to either working in some factory and mostly public sector. So that was a very different world. Scarcity of almost everything, and scarcity of information. And that is the time when I actually, some of those, a working class family, growing up in that, learning about the frugal things, the way you live, the way you budget, the way you plan, and, living within your means. So some of the foundational money things, I was able to develop an understanding. And also, fortunately for me, I don't think that was true for all my siblings. But fortunately for me, I was very aware of the financials, or being aware of the importance of money, and, becoming conscious of all that very early had a very deep impact on me. I was never into any kind of extravaganza or demanding child while growing up.
अच्छे बच्चे थे आप.
हाँ, मतलब बड़ी सारी इच्छा कम हो जाती है जब आपको लगता है कि आप एक लिमिटेड मीन्स में सब चीज़ किया जा रहा है. 4 लोग, हम लोग भाई बहन हैं, पढ़ रहे हैं, एंड देयर आर finite resources, so you just become more informed in a way.
So tell me a little bit more about that. What was your first experience in terms of understanding of how money comes and what it means and how to use it?
No, I was conscious in my childhood, and doing my family errands, I understood that this much money takes to actually do the essentials. But my real brush with, and I grew up in West Bengal, class 1 to 5th or 6th, and it was an interesting phase. But and all my surrounding, everybody was a child of a government employee, and Indian Air Force or the military, Indian Army. And while we were growing up, my father was transferred to Patna while I was in class 6th. And there I had this special opportunity of learning about business. My grandfather had a printing press, though he was a lawyer by profession and he was a practicing lawyer. But running his printing press, I just found it fascinating. I found it very interesting. And I could I would yearn to get back to home from school, to hang around there, see how things work.
Yeah.
And I was able to add all the dimensions. I was able to learn how to compose. Those were early days of, old generation printing press, the treadle machines, where you compose with those types. You did the typesetting physically.
Yeah.
You put it in the machine. You did the printing. You put the ink, and then you did the binding and the pin binding and the cutting,
Yeah.
or printing wedding cards or things like that. So I was able to learn all these things on the go without much of a training. And then came the economics. How does it work? Do we get paid for? How much do we get paid for? Why not more? Why not less? That is when I really understood that how things work. And I think the bigger learning at that stage was working with the set of people, the machine man, the compositor, the binders.
Yeah.
And it was a master class for me firsthand, without being taught in a very formal way.
This was early 80s?
This was early 80s.
Early 80s, right.
Late 70s and early 80s.
When you spoke about putting those casts together and all of it, I think I'm going to tell a production guys to put out something to showcase in the old days how it is to happen.
Yeah, how it is. You will actually have to put each and every, character,
Correct.
set it up, tighten it, and put it on the machine. And if you're a little careless, the whole thing will fall apart.
Yes.
And it was extremely risky thing. Today, the way printing happens, that you put DTP and you do the design and the layouting and send it to the printing press for a CTP. But those days were very different. Doing a single color printing press and understanding the impression, the embossing, or the precision of it and accuracy of it, and your inability to correct it. It's almost it's impossible to imagine the world we have lived in or where we have come from. Like a typewriter to while we are doing something on the computers today, your ability to edit, and you don't have to redo the whole thing all over again.
Correct. While you were talking about putting those things in place, and if you do not put it in the right place, then everything falls apart. Isn't there an investing lesson there?
Oh, very much. In fact, most of the investing pitfalls or most of the financial problem which individuals face is something rooted in basics. Not being able to save early, not being able to be disciplined about it, little disorganized, or getting developing a belief which is completely baseless, or getting tempted by something which will be very risky, dangerous, but you think that it is not based on the context. So yes, I think lack of discipline or lack of rigor in something very basic is very much extended to investments as well.
So that was your early days, and thank you for sharing your story about how you actually learned about your money management skills and running a business, and that taught you how to look at money with a different concept. Now that's more from a business lens. Coming back to your early years of then starting looking at personal finance as a space, and you've been writing for so many years now. Where did that sort of move towards that, let us start something in this field? Because maybe at that point of time, economics, yes, people were writing, but from there to come to a point that you have to take care of your own money. So how were the early days?
It was a set of coincidence. I would not say that it was execution of any business plan or I had some great idea and I went about executing it. Yes, it was a great idea with hindsight, I can say. What happened was I came for my graduation to Delhi, and I came for my graduation to this College of Business Studies. And now it is a very prominent college, but I was the first student of that college. So what happened was I had all the time, and I was reading about businesses and reading the business papers. I will clip the newspaper and organize the information, simply because I had a lot of time in hand, and there was not much to do after the college hours. So, and there were not many friends either. So that was that pastime, 3 years of clipping those information about companies and investments. It just turned out to be a useful resource. When in 1990 I graduated, I had this fantastic, dossiers on companies. And it was completely unplanned. It was just an accidental thing.
Yeah.
And my bedroom, one side of the wall was filled with these dossiers. That also made of newspapers only. And so you look for information on a company or an investments or anything, you can just look at it alphabetically. And something, sheer accident, that I met a person who was entrusted with the responsibility of setting up the second credit rating agency in the country, one Mr. P.K. Chaudhary. And that was also a coincidence that I found him at a place where I bought my computer, my 286 in those days. And I met him there. And when he, and we started meeting once in a while. And purely in the context of fixing my computer or, setting up the operating system or something going haywire. And once in a while, once or twice he came to my place and saw that I have these dossiers on companies. He commissioned me for creating a preview report on those companies on which they will be getting the rating assignment.
Oh, wow.
That was the beginning of value research. And I called it business data systems. And I thought that I have organized all this information on business. And there was no capital. I just had this 286 machine. And these clippings, this was my raw material, this was my factory. And I was, whenever they will get an assignment, I remember those initial assignments. So 2-3 companies I remember on which I created these, summarized the dossier into a 1-pager or 2-pager for them. And that was an input to their rating assignment that they had, the work they were doing. So that was quite that was very encouraging, not rewarding. It was rewarding for a student, but it was very encouraging that I was doing something very valuable, and I was doing something, and I got a lot of encouragement from those people or appreciation from them that some kid can actually do this and not be spending time in cricket and this and that. So that was a big booster, but. What subsequently happened was, 1991, the start of the public sector disinvestment, and I was able to convert some of those dossiers on those PSUs into a report on those companies, and that was the beginning of independent research for me.
Wow, and what a year to do it.
Yeah, we are so much of a product of the context of the incident, the situation. The Indian economy was liberalized. Indian government was forced to disinvest. Mutual fund industry was opened up for private participation. And before that, and accidentally, I was at that crossroad. I was in the college. I was doing my master's, and I was in Delhi. I was able to walk into the office of Economic Times and straight to the editor's room and say that here is a series that I've worked on. And today's newspaper carries an ad on the disinvestment. Would you be interested in carrying it? So all these things is a matter of 1992. It could have been done then only. And it was not that I had some great plan and it worked out. It was just that I was curious about something and I was interested in something. I had put it together with great rigor and painstakingly, and I was able to find a customer. And that was the beginning. And then that was the very early days. I soon realized that this company research, stock research, or PSU research, I was able to make some money from Economic Times. I was also able to make some money from some very wealthy, some foreign investors who wanted to pay me for my hours of time spent with them. Yeah, for research. Wow. Okay. But that was one-off. You can't really build a business on that. So what but that all these things turned out to be footsteps. That is when a couple of months later I was able to put together a scorecard on mutual fund and go to Economic Times once again and said that this is an opportunity. This is something, if we are able to, most mutual funds then, about 80 of them, there were more, but 80 of them were listed. And all the mutual funds which were listed were trading at a huge premium to their NAV. And finding a customer, persuading him that, publishing this information of NAV and price together at one place will be a great service to investors, understanding of what they are getting into and how risky it could be. And that was also my first brush with understanding of, how information can really demystify things, how it helps you gain clarity. And in a matter of, couple of weeks, that that scorecard appeared in Economic Times Investor Guide. Of course, it continued for next 10 years, or even now it appears in some form in ET Wealth. But those days, Investors Guide every Monday. And I will have this great, pride in of those days that most funds which were trading at 1,000%, 1,500% premium to its NAV, it disappeared. It vaporized in a matter of, few weeks ever since this scorecard appeared.
Yeah, I think our from a regulatory lens, if you look at our industry, probably it's one of the most transparent ones.
Yeah.
And it's very important that such informations are even put out in more clearer fashion. And the reason for doing this podcast is also to sort of demystify a few things for people. But for me, what's interesting is in 10 years, you went from one side of the printing press to the other side of the press, from the input to output. How did it feel?
It's a journey. It's a flow. And I don't think much of it was planned. I just stuck to, but what happened in the initial years was I was able to articulate some of the values, which is enduring, which is something which should be held dear. Because my understanding was, I did not think very hard before starting value research or creating that mutual fund scorecard or the public sector series. It was a hobby. It was a pastime. It was something which I liked, and I was able to productize it.
Sure.
But thereafter, once I understood the impact of it, and then I started learning that what are the responsibilities resulting from these actions, and what are those values which I should imbibe so that it becomes a durable thing. And what came to my mind was people trusted blindly what appears in print. And you have to be extra careful. You have to exercise extra diligence. You don't have to just jump onto something. You don't have to sensationalize it. You have to do your groundwork before you form your opinion.
Right.
And initial years, I remember that, 1993, I started putting that scorecard. Then the editor commissioned me to write a fortnightly column. And that fortnightly column, I was not confident enough to write that fortnightly column. I did end up writing interesting commentaries. It looks interesting, this is something that has changed. But I will just stop before making an opinion that this could be dangerous or, this could be nasty. I just thought that, mutual funds run by these big institutions must be doing it right. I may not be knowing the complete picture. I may not have the complete picture. And that is when I was stopping it, I was told that get to the point, conclude it. If you don't clarify it, if you don't simplify it, if you don't communicate with simplicity, commentary doesn't help. Conclusion is important. Decoding things for somebody to understand things, and that too for somebody to understand who is generally, everybody took great pride in those days about their naivety about finances. Even now too, but those days it looked like, if I'm not smart about money, or if I'm not very concerned about money, or if I don't worry about how I manage my money, I'm a nice person. I'm not money-minded kind of thing. It was a matter of pride. And if that was the time when I realized that every person was a saver, but nobody was an investor. And mutual funds were dominantly closed-end fund. Everybody used to do periodic investment in IPOs. IPOs used to be very rewarding if you got an allotment. But nobody ever thought that, he's becoming an owner by investing into a company. Nobody thought that he's investing in a bunch of companies by investing in an equity fund. there was an element of lottery, and it was substantially the speculative mindset. And the initial mutual fund experience also was almost speculative, because what happened was the launch of equity funds in India. Though Indian mutual fund is very old,
Yeah.
the UTI and Unit 64 and 64 onwards till 1986. But 1986, even the public sector mutual fund, which was still not privatized, that's our turning point. The launch of MasterShare, the first ever equity fund. Before that, there was no equity fund. So the launch of first equity fund, investor invested in those, and it was a closed-end fund, and it started trading at a small premium, sometimes at discount, but it was anchored around its NAV. And initially, it had some 8 or 10 years term, and then it was followed by a couple of very other ones, and some of those funds, they started trading at huge premium because it coincided with the Great Indian Scam of 1992. And there was complete dearth of supply of those closed-end fund. And that is when we saw that big, master gain thing, and a lot of investors queued up to invest in those. So the mindset around investments was substantially speculative. Everybody was, and that is the time when I also realized that Indian investors had access to very high quality fixed income long-term vehicles. PPF was a popular thing. Small savings scheme, everybody had it. Public sector bank dominated the fixed deposit arena, and money was absolutely secure. And when it came to equity and your longest term investment, your EPF and the public provident fund or the government provident fund, they were all fixed income, completely fixed income. And once in a while, you will have this periodic IPO or this mutual fund, which was also relatively new. So long-term investment was fixed income. Short-term used to be, or short-term speculative, thing used to be equity. And that is what actually made me think that there is a need to really create awareness about it. And the beginning of mutual fund, which coincided with I coming into being as a small firm creating scorecard on mutual fund, was just, it was too much of curiosity, too much of thinking, and very busy creating. I launched my mutual fund rating in 1993, and that time there were only closed-end funds. So the editor of the newspaper wanted me to create one. And I was completely out of idea that what is the point of creating a rating which people can't use because people could not buy it. And the mutual fund were listed. But what is the point of buying or selling something which is trading at a huge premium or discounts to its NAV? And you can't, the NAV which was disclosed on a weekly basis, that too with a long lag, had virtually no meaning, and by the time you will hold it till its maturity, it will be completely stale. So rating which could be perceived as a pointer to the quality of something or pointed to, and there was no point in rating a new fund. But still, I got going with some of those things, and those were the initial learnings. And that actually led me to think about, individual investors' curiosity, the impact of information on people's mind, how long it takes for people to believe in something till they see the facts, and even looking at the facts doesn't matter. It takes much longer for people to experience the debacle as and when it happens, which typically happens, and I've seen quite a few of them.
What you just summarized in your response at this moment is how people used to perceive information. It was largely print, sometimes maybe something on television, very rarely, but not too much of
no, virtually nothing on television, because television till early 2000, late 90s was only Doordarshan.
Yeah, sure.
And I used to do one program on Doordarshan, which was, a few rupees more. That was a weekly program on investments and IPOs and mutual funds, and it was a disaster for us business wise. That was the first ever program. In fact, we had a a star presenter, Jairam Ramesh, those days, who was, I think he was a journalist then, used to present that program, and that kept running for about 2 years. And that was a financial disaster because it could not get sponsors. It turned out to be a very damning thing for the sponsors, for the persons, creating it.
So today, as we sit in 2025, technology has played a very large role in dissemination of information. And from that print to today to come to doing it on a platform, building this community. And now there are many websites like this which are giving out information. In your experience over the last 30 years of doing this now, how do you think technology, where did it intermine, and today where does it sort of stand
No,
in personal finance?
sorry,
In personal finance space.
in personal finance, it has radically, it has revolutionized the whole thing. It has democratized access. In fact, when I remember, I have the privilege of, understanding how the world
You're the
was.
only one I can ask this question.
Yeah, I have the privilege of, looking back and seeing that how the world was and how the world is and how it has evolved. You know, if you had 5,000 rupees or 2,000 rupees in year 1990, no broker will ever entertain you. So that access has been completely democratized. Now, access to everything, including information. The problem is that technology can't do a damn about the behavior. And that is something which investors, and in fact, technology has also contributed to the misbehavior, or helping you misbehave, or helping you with a false sense that you have more information. For example, early 2000, we have this business channels. And the real problem of business channel is not that they are wrong or right or this or that, but simply the investors watching it, they have this false perception, understanding, false notion that they are now an insider, having access to people firsthand, listening to them. People don't look at it as a source of information. People look at it as, a false pretense of having more knowledgeable about things, and more knowledge translates into some advantage for them. Not really. Likewise, the way people are getting, and the way the media has been democratized, everybody is a publisher now, including us right now. And if you have something meaningful to say, you are able to get an audience. And who takes how seriously and how he acts, that is leading, and I think too much of unvetted, unserious, less serious media getting created. So I would not like to, I'm not complaining about it. I think,
No, but you're making a point that when people are watching this news, people are watching this something being published or it's flashing across, that they feel that that's the truth and just go by that. Whereas it could just be part of some information beyond.
It could just be an entertainment. It could just be, somebody's ploy. Somebody could be doing a con job, and that is something which we see time and again. And the regulator has worked in that direction. They're trying to do something about it, but there is absolutely, so this has been democratized. This has, technology has enabled great access. Technology can't do anything about the behavior. You will get greedy at the wrong time. You will get fearful at the wrong time. And you will have this plenty of media which will drive you towards that. And it will be in somebody's interest, being suspicious, being, being in a rigorously probing mindset. You have to start, what most editors tell you, that you have to start with the whole thinking that I'm being conned. Now something has to prove that you are not being. Unless you get to the first principles, why you are being targeted. You have to look yourself as a prey. And then you have to validate information so that you can make sense of it. What is the business case? What is the context? Why it is so? Why it is not so? And this is the opportunity. This is also the biggest threat. And this is actually biggest challenge for most individual investors, how to manage their own behavior. They could be their worst enemy.
So considering what you just said, can you like sort of demystify for them? In market cycle, generally we see the behavior sort of change. It's a bull cycle, then like you said, the greed sort of sets in. People want more, even if they have certain goals set. They may not exit at that point of time because they want something more than that. And probably it's the most opportune time when markets are in volatile phase. You tend to sort of go about saying that I'm going to wait for some more time. And what you just mentioned about what comes to you and what you're reading, whether um, media is just not just one part of it, your WhatsApp communications,
Yeah,
your
yeah.
emails, uh, maybe now chat GPT, you're going to read a lot of stuff which is
And the
anyways.
way things get viral, yeah.
Yeah. In that ways, if I have to just put out like say 4 5 things which you feel that, look, if you want to do this, then just check these 5 things and then move in the direction you want.
Yeah, that's the most important thing. And that's the hardest thing for most investors to even decode that. Reason is that most people get attracted to the market or start thinking about investments uh, when it is generally inopportune, when your friends have made money, or you're being told that you're missing out, you're missing the bus.
The FOMO.
And that is the easy time, and sometimes you are able to ride it, sometimes you ride it for a while. uh, and that is when you don't have the rules. And when you don't have the rules, then you don't know what to do. I think the biggest threat which individual investors face when they get attracted to the market in this context, in this phase, is that they are driven out of the market forever at the most inopportune time. And because it is, market, their first experience with market or with anything in a speculative market is at a time when they start the whole exercise with the biggest expectation. So biggest expectation, biggest dreams, and that being completely drained, that
Yeah.
being it turns out to be one of the biggest disappointment for them. And when they are driven out of it, they don't come back. They really don't get an opportunity to frame their rules and get back to it. So it is very important for most investors to frame their rule book. When it is very noisy, when it is very easy, you have to really work on those guardrails, what all you will do. And the biggest, uh, I find that most investors don't really work on the foundational things. Everybody is a great saver. In fact, that is something which we are told from childhood. Even with our pocket money, we are being told that list where you're spending, and keep track of it. But when it comes to why, where, and have you done the groundwork? Because when you don't follow those rules, for example, if you don't have your foundational money, then the moment you hit your first loss, you will bail out and never to come back again. Likewise, if you put your short-term money into long-term investments,
And
you will never
reverse.
experience it.
Yeah.
If you put your long-term money into short-term investment,
Correct.
it will be disappointing again. The whole country has been buying those policies or deposits and expecting magic, which never happened. So you don't come across great success stories. So, and the charm of regular investing, something which fits in with your income cycle. You earn, you save, and then you invest. And why accumulate and then invest, which is still very rampant. So I think having some of those very basic tenets, and I think it should become a very essential part of our school curriculum. If it becomes one, it will be very helpful.
Uh, Recently, I'd gone to an expo where some investors had come, and I heard a saying that the biggest scam in the industry is long-term investing. Very young, a 23-year-old boy who had concluded it is that way because uh, the years post COVID actually made people do a lot more trading,
Yeah.
right? To the younger lot today who are accessing platforms like yours, coming in reading, and then trying to build their own dreams and investing, they do not come from the same school where earning money was difficult. Today money is being earned. There are people who are getting jobs in different fields, and their experiences or maybe their understanding and going ahead is different. What is your advice to those guys when they're starting off today? A lot of them are actually pivoting to more of trading mindset,
Yeah. Yeah.
or stock investing mindset. What is your advice for them from a
Earlier, I used to be very cynical. I thought that everybody should learn and then go about doing things, and that is how I did.
Yeah.
But I think things are different because most youngsters or most young people today, they are coming from a background of a different family than mine, and they might, and they're also starting affluent. Uh, it took me many years to start saving because I had many of those essential expenditure and the credit was not easily available.
Right.
For them, it could be different. They start their first job and where they have those surplus and they have and the interconnectedness, the WhatsApp, your ability to get started. As I said, that access has been democratized. If you decide to invest today, you can get cracking in about 15 minutes.
Right.
If you have an online bank account and the
Sure.
smartphone and connectivity. But they think access is not wisdom. Access is not, now it is there. But I still feel that most people should try it out. Start with your experimental money. Start with your 50,000 rupee. Don't go more, don't go less. Do it with that, or start with your 10,000 rupee. You have to experience it. And in fact, you should experience it as early as possible because the myth around it is that it could be a rags to riches story. And most people think they will be deprived of it. They should try out, figure out. It is important, and what SEBI data says that 92% of the people lose money. The problem is everybody thinks that he'll be in that smart 8%. So give it a try.
Yeah.
And see how much it is. Make your fun allocation. Make sure that it is. And then on the other track, get methodically. In fact, at Value Research in last couple of years, we have had this, we had a completely changed, profile of users. People lose and then come over. And then they become a regular, normal, long-term or, medium-term, thoughtful investor. So many a times I find that, till you have experienced it, you find value research very boring. And once you have done that, once you have experienced that, then you find it very interesting. And then you become a fundamentally guided investor, whether it be mutual fund or stocks. And being a fact-led investor, having done your groundwork and done your preparation so that you could be benefiting from the market madness methodically and how and why and how things work. Because people experience market in a manner that it turns out to be dabbling the market,
Right.
gambling in the market, or giving it a try, or you were lucky. But people are unable to decode that what is the method, why things behave the way they do, why stocks go up, how things, is there a connection between earnings and prices, for how long it remains disconnected, when it actually follows, why it generally follows, why it always happens, so people have very little understanding. People think that you bought because and also when you look at the media, when you look at the cinema, popular cinema, and the context in which stock market has been portrayed, or if you look at the serials in last 2-3 years, the popular ones, it has all been about the market scams. So the people have this sense that good till it runs and otherwise there's no basis to it. The deep-rooted belief that it is something speculative and you can do something about it. You can decode it, be methodical and benefit from it, has not permeated. And at a young age, you have reason to be very confident. You have all your working life or earning life ahead of you. So I would say that people should try, lose money early, and don't postpone it in your 40s, because if you try it out then you'll lose big time.
True. Staying on that topic, since you've come across so many investors and so many of them talk to you about maybe possible mistakes they have done or they've done, and then, like you said, they do it and then they come asking about it. How do we go about it? Uh, in your experience so far, what are the top 3 mistakes people do?
One is that not do the foundational thing. They haven't done the money that they need in next 2-3 months. Uh, they haven't got a health insurance, and that can derail all their savings and investment plan. You are just poor, turn poor with one hospitalization sometimes, and that can completely derail your very long term, medium term investment plans. And also chasing recent past performance. Most people do this, and that is a recipe for, investing is all about buying low, selling high, and giving it time. And people just do the reverse of it: buy high, sell low, and
Give no time.
go away, and never without much time and without giving the time, and then you regret it. So I think these are very basic stuff, and if you don't get this in place, if you're onboarding or experiencing the market at the outset is like this, uh, and this is where I feel that the old time mutual fund or stock, the context was very favorable, because I still come across many success stories. The person who bought his stock in the physical form and got invested in 10, 15, 20 companies, and he couldn't sell it simply because he got transferred, or something happened, and selling was not easy. And uh, and despite 5 of those companies dying in the process, they disappeared, but something or the other, I come across all those kind of investors every now and then.
Those people have made money.
Those people have made money. So the cost of the reward of patience and forced patience, so to say, because what has happened as a result of this technology enablement and access is that there is no patience, and it is so easy. Sometimes you just might like a impulsive spending can trigger a long-term investment liquidation.
Right.
So how do you? So that is the other side of it. Uh, so I think these are 3-4 foundational, and then somebody having this deep-rooted belief, not in himself, not in his plans, not in his own goals, not being guided by goals, I think is another thing. If everybody gets so methodical about choosing a cell phone or a washing machine, and they are so passive about making that investment, which can have a lifetime impact.
If you have to define in one line what a goal actually means for an investor.
A goal is that, when will you retire, and have you done something about it? When your child will get into college, what have you done about it? When you want to buy a home, because even home buying has become quite speculative in recent years, and it has benefited a lot of people, and a lot of people have also been stuck sometimes, and people don't look at home as a home to live in, and something which you consume, something which gives you emotional comfort, something which gives you it's your shelter, and it's a fallback, it's a foundational thing. So having these some 3-4 broad goals which most people have, and leaving a larger state maybe, and how to make sure that you have done all the groundwork, so that it is not subject to speculative ups and downs without much of a plan.
Yeah. Because I always felt that goals actually give you exit. I think without a goal, exit will not be possible.
Yeah, without a goal, there may not be an exit, and only leaving a larger state could be something where you will exit, and but then you will be happy about it. That at least your money will be, because I come across this deep belief that once you have retired, you have to take retirement from risk as well, and equity is risky. You have to put all. Why not leave a larger state? Why not actually have a withdrawal mechanism, which is a very insignificant part of your total worth? But this is something which requires education, which requires understanding, which requires people experiencing equity investments over a long term in a very methodical way, to be a deep believer in this.
Coming to the mention of equity, we have seen the last 20-25 years of Indian markets that while people generally believe that long-term equity is the best instrument. We have a big competitor to equity called gold, which has also delivered almost similar returns and sometimes maybe ahead of it, while equity will later catch on. But and we talk about asset allocation, deployment in various places. What, as per you, should people look at from an one is from an asset allocation perspective, and then from individual assets, what one must expect? Because that's a question we generally hear a lot from people, that मैंने गोल्ड में इन्वेस्ट किया था, मैंने घर में इन्वेस्ट किया, मैं तो एफडी में लगा हुआ है इतने रुपीस पे, इक्विटी में लगा हुआ है, बट ही नेवर टॉक्स अबाउट a rounded approach or combination of that. To them, what is your say from an asset allocation and individual assets?
I have a take on this from 2-3 dimension. One is that it should entirely be goal oriented. Short term money should be into almost semi liquid money which you can access, and it is not exposed to any market risk. When you need the money for your next month spending, it should not be less. So it should be parked differently. So that is one part of your allocation. Medium term money, where 3 to 5 years, 2-3 years, 4 years, that money should be in fixed income, so that you don't have to lose your sleep on an imminent spending that is required. 3 to 5, 7 years, I think it could be a hybrid investment, so that you are able to, because fixed income will not help you beat inflation. Your money might remain static with fixed income. So that is where you can have that hybrid investments. And beyond that, long-term investments, any goal which is more than 7-8 years, should be into equities. Which kind of equity? Domestic, small cap, mid cap, and there's a complexity there. Most investors don't really spend time learning about it, and they should not. How to go about things in a simplified way, and why. A definite belief which is guided by numbers. Why diversification helps. Why investing abroad is important. How to make your money sheltered from or a tax sheltered investments. This is one benefit of generally mutual fund, which is not even understood, that you invest in a mutual fund and it is an actively managed portfolio, and you are not liable for any taxes till you realize it. If you take your money out after 50 years, that's it. All the money.
Who knows if the tax is favorable then? Who knows?
Who knows? But if, of course, depending on your own need, if you are that lucky to actually leave it work for 50 years, maybe you will. I don't know, 50 years and what taxes will be, and if you are a developed country and we have very high taxation rate, but having meaningful net worth is just as important. It is all going to be a very relative scene. So I will say that this is one aspect, being guided, an asset allocation guided by the goal. Second is that you should asset allocation and rebalancing. How to do it with simplicity. Do an annual rebalancing, and without rebalancing, asset allocation does not work. And how to this is to be done only once you have something to lose, because one aspect is missing the bus. That is how investors start, and the other aspect is when you have something meaningful, and when you see a massive blow, you are also scared out of the market, even if you have reason to believe that things will turn out to be good. And that is when you need the asset allocation and the rebalancing principles. Having your own rules and keeping it simple, doing an annual rebalancing, I think that should work out for most individual investors.
So that's the second dimension.
That is the second dimension. Third dimension is that, don't over-engineer. Because the moment you cross your short-term money into long-term, or long-term money into short-term, it is going to be a very damning thing for you. And you will only have regret with hindsight.
Sure. Can we add technology as the fourth dimension from execution speed possible?
Oh, that is something which is going to have a magical impact if you are ability to automate the way. All the things that I'm saying would have been a nightmare for anybody to do it 20 years ago, 15 years ago. Today, it is possible to do it. and you can do it in any of the platform. That when do you want to rebalance, why, and you can document it. My suggestion to most people will be, have a plan, make sure that you're following that plan, and try and automate, and go and live your life. Don't stop worrying about investments, stop worrying about that influencer, stop listening to me. And if you are able to work on some plan for yourselves and enjoy, because in the process, people who get attracted to the market, they get very enthusiastic about it, and then you lose interest in the core work which was getting you the earning. That could be one of the biggest danger you will be exposed to. Master your craft, do your job well, and that is going to be the very foundational thing for all your savings, investments, and living joyfully. And if you're able to automate this and do it methodically, you can do the primary job very well.
Yeah. And we are the most youngest population on the world at the moment, and so many investors are yet to come. Our PAN adoption ratios are now started increasing. That will eventually convert into new investors coming in. See, 3 quick things for them. Where do they start? First thing, what they should start. And
First thing is start somehow.
Somehow. Okay. Fine.
So start somehow. If you are, and start somehow in the sense that, investing to begin with is a very difficult thing, and more so for a youngster, because you're postponing your current consumption and for a future benefit. And investment is, deferred consumption. So why defer it if you have plenty to consume even today? And that too, given the supply of, novel things, or, we grew up in it at a time when the supply was limited. I don't know if you will not remember, there was a phase when we had to wait for 10 years to get a telephone connection.
Oh, yeah.
5 years to wait for a scooter.
I think we wait. Scooter, I remember, 4
Yeah.
years, and telephone was maybe around 3 years.
Yeah, so 4-5 years for getting a Maruti car was also very usual. And I remember, in 1982, the Asian Games village, and people were smuggling television sets because, color TV sets were not produced in India. And any foreigner, any non-resident coming to India was coming back necessarily with a massive television set. So, we're coming from a starved economy to an economy which is abundance, easy credit, and it's very difficult. So, start somehow. Somebody, I'll just give you an example of somebody with great difficulty. If somebody is saving 500 rupees, having 6,000 rupees at the end of the year, assuming no return, will actually make him feel very rich. And if it compounds, there is no teaching possible unless you experience it. And whether it be 10%, 15%. So start somehow. If not a mutual fund, and you will have this excuse, which is the right fund, which is the right stock. Start with a recurring deposit. It is available in the friendly neighborhood post office. Because getting this basic lesson and having some money, having that elbow room that you have 6,000 rupees while saving 500 rupees was very difficult, will have a very magical effect on your own mind. You will understand discipline. You will understand compounding. You will understand accumulation. Then comes keeping it simple. It's very difficult. Only after you have messed it up that you understand why simplicity is the ultimate sophistication. So, today at Value Research, the largest number of questions that we get is that people send us a list of these 30, 40, 50 funds that they have. They want to simplify it. And they have many funds which are good, plenty of, but, complicating it, being a collector and, having a quasi, index kind of over underlying portfolio without any accountability, without any triggers for you to act, without any orientation towards your own goal. So I think, start somehow, mess it up, clean it as early as possible. And I think that is part of the journey. And eventually, once you settle with a simple, disciplined approach, and if you're able to do all these experiments, starting with your day trading, F&O or whatever, in the first year itself, I think that is a price that you pay, and it is well worth it. And I also feel that if you have some of those instincts, if you have some of those likings, do it as early, because any amount of podcast, listening to podcast, or my teacher, my columns, or anybody's writing, you have to lose a little bit of your own money. Earlier you lose, you know, less expensive it will be.
Before we let you go today, couple of questions on any quote, any book that you've read which has had an impact on you and your writing thereafter.
Plenty. My nature of my work is something which forces me to read for ideas and understanding, and and one of the biggest rewards of my job I have chosen to has been that it forces me to learn every day. But I think one thing I'm quite amazed, and one quote which is we are our worst enemy. And if you are able to manage that, if you are able to comprehend that, and if you are able to manage our behavior, that is going to be, it has been a learning for me. I never understood this early in my career. Now I do.
Any book you would recommend?
I would say when it comes to stock, it's One Up on the Wall Street. And childhood memory of reading Vivekananda and Advaita is still, it was very impactful, and kind of being disciplined about few things, and having that basic that rooted in a thought process will be very helpful. And that is non-business, non-economics, non-finance. But that I think is very significant. It significantly influences your behavior.
And if I may ask, any movie which you've had really, you go back like, kuch nahi hai, to let's see this movie.
Oh, I can watch Sholay once again, and that could be 100th time or maybe more.
Fantastic. Dhirendra, thank you for talking to us.
Thank you.
It's been a pleasure talking to you today. A lot of learnings, and I think we hope that we've sort of rekindled your old memories and your earlier days.
Thank you very much for reviving some of those. And if there's one thing which I would like to tell people to do it intensely, write a plan, automate it, and go and enjoy what you like doing.
We'll leave it there. Yeah, thank you so much.
Thank you.
Thank you. We'll see you again on another episode of Let's Write. See you till then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.